What the data is telling us is look at seasonality. Of course, sell in May is a very popular adage around this time of year because typically the summer through Halloween is not the best time in the market to be invested. But we're going to look at a couple of different things based on seasonality, as I always like to, and a couple of other things that might be completely different that might be worth paying attention to. And I did mention them last time, so we're going to actually dive into them this time. We're also going to look at current money flow stats like we always do, just the context of the current market, kind of understanding where things are, what's working and what's not. Good snapshot there. And I want to spend a little time on the Ulcer Performance Index, why it's important and how and why we use it daily. And it's made a really big difference over the past 6 or so months since we've been doing that. So let's start. All right, typical seasonality of the midterm election years. Typically, you have a sell-off here. Into February, a run up. This is not at all what's happened this year. It's been quite different, actually, but flat and then down and then up into April. So this is just not even working out as expected. But I always want to know what could happen. But for now, this is really not the way to look. Then we look at just the last 10 years. This is a little closer. You get a sell off in March. That makes a little more sense. And then that suggests a run up into, mid the summer instead of the sell in May that you usually see. So that's interesting. But where it gets really different is when you take specific years of the current president and when he was in charge. And it's a very, very different chart than both of what typically happens. Right now, 2026, we had really a nowhere market. To March, it had a really steep sell-off. It was close to 9% to the S&P, a little more for the NASDAQ. So that's common pullback, nothing, not a bear market by any means, but something worth noting, something worth paying attention to. But then we had a very quick reversal. Look at that. It bottomed right around, late March, just like it always seems to do very consistently during these specific years. And I thought it was really interesting because once you have that played out, not much happens for the rest of the year. It actually goes pretty well, which is interesting because typically the second year of an election cycle is really not the best year. It's the highest probability of not having a positive year in the market. So that could still play out. But for now, if this tracks, and this is what's tracking the closest right now, we actually may just have a boring, slowly cruising upward market through the end of the year. It's possible. There's always dips along the way. There could be something that comes out of nowhere that we're not expecting. But for now, this is the playbook that matches the closest to what's going on. All right, looking at our data, I mean, the money flows is good. We had a great run out of the March lows there, obviously. But then since then, really, it's not a whole lot. Not a lot of broad participation. It was very tech driven, and still that's where the leadership is. As for now, we're still kind of above this purple line, and that's really where it care. You want to be defensive down here, and up here you don't really worry about it too much. So we're holding up well. This is an early warning, but we're being near that line, but we're okay. Nothing too concerning there other than, we're not getting a lot of new money flow into the market. We're also seeing that on the shorter term. The market peaked somewhere around the 20th of April. And then money flow has just kind of been weak and not real exciting. It's even showing that it's not, we're below that negative 200, which is really interesting because, the markets are up today, 1%, somewhere around there. And we've also been grinding upward, but there are other sectors parts of the market that have not gone anywhere. They've just kind of gone sideways. And maybe that's what's contributing to this number. It's really more tech again that's driving upward movement rather than anything else. And there's always spots along the way that are working as well. So looking at the market indexes, of course, the NASDAQ and S&P, those have a confirmed uptrend. Latin America actually has a confirmed downtrend. So that's an interesting balance. But a lot of this other stuff, the Dow, the small cap, mid cap, emerging markets, it's not, not super positive, kind of underwhelming. But, if the S&P is going and it's trending, then the perception is that everything is good in the market, where the underlying, there's some things that are not as strong as they probably could be. But, as long as these two are trending up, there's really not a whole lot to be concerned about because the NASDAQ and tech is really the largest whole part of the S&P. So that if that holds up, then, the S&P is going to hold up as well. But we're not going to be too concerned about market pullbacks, at least just yet. Ranking the sectors, there we go. XLK is the technology sector, trending upwards, and it has been for a while. There's a lot of the defensives are over here, and actually utilities, a big defensive is trending down as a confirmed trend. Not super exciting. Interesting that XLC is over here. That's communication. That's kind of another tech area, but it's really just a messy mix. It's not real inspiring. There's not a whole lot trending up. We've got these XOY, it's consumer discretionary, industrials, and real estate all kind of starting to roll over. I'd be curious to see where they are after today, but that's not real positive. But we still have XLK, technology, and XLP, consumer discretionary. That doesn't really match. That's like defensive and offensive, both leading together. Doesn't, it's just kind of a mess out there. And if you look at the RRG charts, watching the ducks go around the pond, they're all just kind of clustered in the middle. This isn't an impressive or inspiring market to be really aggressive in. Now, back in the bend of March, they all clustered down in here, as I love to see, and they all shot up into blue, into green. And that's just a really good setup, and we were able to take advantage of that. So I'm very happy that that played out. But now that's done, and tech is certainly the only outlier way out here and leading. It could roll over pretty quickly, but as of today, it's pretty good. I'm not super concerned, but there's really just nothing. There's not a lot of leadership outside of tech. Everything else is just kind of bumbling around in this middle. It's not really going anywhere. If it's bad, they're pushing out into here. If it's improving, they're pushing up into there. But clustered to the center means they're really not going anywhere. Let's wait and see where it's going to go. Looking at new lows, that's always a pretty interesting thing. We actually did jump above 100 typically. I look at this inverse, so it feels like the market going down below 100 yesterday. That was interesting. And last time we had this webinar, I think we had hit right there, and we had a good run for about a month, and that makes sense. Now we're just kind of cautious. This isn't bad. As I always say, back in the tariff tantrum a year ago, April, this went down a negative 1,000. This sub 200 is not really a scary number. This is you should pay attention. If we're above 100 on the new lows on the NYSE, then pay attention. It's not the end of the world, but just see what's going on going forward. Onto the UPI, Ulcer Performance Index. So this is something we've been implementing more and more, both as what we invest in and how we view our models and how they are acting. We wanted to start scoring based on risk, right? Because we always talk about, the point of what we do is to manage the downside in bad environments. And we really haven't had a whole lot in the past few years to measure, but I still want to have a way that makes me understand when we get a pullback like we did in March of about 9%, how did we hold up? Were we in the right spots? And then it helps us pick investments that will hold up in those environments as well. The big place where it's really held up is we have a market neutral model, which is very heavily based on that thinking, and it held up incredibly well. So we're trying to lean more and more into this thinking into our strategies. So what the UPI it's similar to the popular Sharpe ratio. It's a return of unit per volatility. So we're thinking about volatility, but it uses the Ulcer index instead of standard deviation. That cares about the downside, right? I care about the downside more than upside volatility. When things are good, upside volatility is fantastic. So, no complaints there, but you want to pay attention to the downside volatility. And then, of course, the basic formula is based on this UI score. Of course, the higher UPI number is the better. And this says above 1 is generally decent. I find it's really a relative metric. How does this model do? How does this fund do, investment do versus a benchmark, like say the large cap growth index? How is that doing compared? And then you can pick things that have lower volatility, but still can keep up return-wise. That's really kind of where the magic happens, and from what I'm finding. Key advantages of that, it captures both the depth and duration of losses, not just the worst single drop or overall wiggles. I like it that AI came up with this definition. Focuses purely on downside risk, which matches investors actually feel. And I think that's a key, is when investors feel the losses, they start to make not so good decisions. In my experience, they start to go, oh, we need to be defensive. And it's probably the opposite. But when we're using UPI, it helps you not feel those losses in the same kind of way. And it really helps you be resilient, helps you participate when you get these very rapid return improvements that happen very quickly. So yeah, it's useful for comparing fund strategies portfolios, which is what we're doing now more and more. It also gives me a heads up if something is not working as it should. I think this has given us the best handle that we've had probably ever of understanding what's working and what's not, where do I need to spend some time and make sure everything is working as it should. So a fun, quick little exercise will show you the 3-year sector spiders. What's interesting though, we're looking at the UPI scores, and I have the best metrics highlighted in green. So XLC, interestingly, actually has the best UPI score because its drawdown is pretty good, but the return is not as high as XLK, which is the technology sector. No surprise that technology is the top place to be, but it has a higher standard deviation and a bigger drawdown. So that's, so that dings its score a little bit because it could have a downside. So it doesn't score as well as XLC, but that's a trade-off that we're thinking now. Now, then you go down to standard deviation that's low, 3, with the best drawdown is 12, but you only get 6% for that. So that's probably not worth it. That's why the UPI score is very, very low. So it kind of helps you understand which things are working. So in this context, when you look at it, it's like, wow, really only these top 4 are the sectors may only be worth looking at. because these ones don't add a whole lot of value. They add a lot of risk, but they don't add a lot of value. And I think that's just an interesting way to come at how we look at our investments and our strategies.